And Mike Santoli brought up the ARK thesis on Tesla. So ARK Invest, super bullish on the stock. And part of the thesis is that they can insure almost half of their own cars by 2025. Now, that's not necessarily what's going to happen, but is that a risk that some of the manufacturers themselves could provide direct insurance to consumers?
No doubt. You think about what's happening to cars. Tesla is a wonderful example of the connected car, the electric car, cars moving from being mechanical platforms to being computers on wheels. And that has profound impact on insurance. One question is, who insures what? You go to Phoenix today and you order a ride-sharing cab. Some of them will come without a driver. Who owns the car? Who owns the service? Who owns the insurance policy? The person who's driving it. There is no driver. So there's going to be massive dislocation in this entire sector. And the data implications are profound, and they aren't good for incumbent insurers. Tesla can do what you're saying because they have live data feeds from the device which tell them how much you're driving, whether you're driving in roads that are prone to accident or safe roads, whether you're driving carefully or irresponsibly. And all of the pricing of insurance until now has had to look at big groups of people on aggregate and price them on an average. As soon as you can break apart that average, that monolith, and price people using specific data to them, you have a massive advantage that incumbent insurers don't like. Because if you have a $30, $40 billion business, as Geico does, as Progressive does, based on pricing to an average, you don't want to adopt these new technologies because suddenly you'd find that half of your customers have been overcharging and you have to reduce their premiums. That's no good. And the other charge you have to raise premiums for and lose them, and that's no good. So you see folks like Warren Buffett being really hesitant and dragging their feet about adopting these new technologies, really ultimately doing it kicking and screaming because this transformation does not favor legacy providers.
So, I mean, fascinating take that, Daniel, in terms of disruption in the insurance business, but also raises a question for the likes of Tesla and other self-driving technology providers and designers. I mean, who is the person that needs to be insured in that sort of world going forward? I mean, is it Tesla that will need to protect itself against lawsuits as opposed to the passenger or the owner of the vehicle?
Quite possibly. And this goes even one step further, which is today we buy Teslas, but you can envisage a future which is not too distant where you merge Tesla and Uber and suddenly you're ordering a self-driving car and mobility becomes a service. You don't own a car, you use a car, and it really becomes a service rather than a piece of hardware that you have to keep parked outside your home. And in that case, the question goes even further, like really, who is insuring this? In general, I think you're going to see car insurance shrink. Over the course of the next decade, if you're sitting on the board of directors of one of these big incumbents, it's pretty daunting because you're going to see the total pie shrink. Accidents are going to decline, car ownership may well decline, and in any event, some of those dollars are going to move to businesses insuring fleets like Uber-style kind of scenarios rather than individuals owning them. So for incumbents, that's a disadvantage. But when you're starting not with a $40 billion business and you're worried about it shrinking, but from zero, there's tremendous upside and a lot of cannibalization that you can do into other people's businesses by adopting these technologies just as this disruption takes place, as this dislocation hits this industry.
Shepard Smith here. Thanks for watching CNBC on YouTube.